So you're an $800,000 sole proprietor, or you're making about $1 million net. You have no LLC, you have nothing. It just goes on a Schedule C. So you're running a business. You got this net 800,000 with minimal expenses. You're doing great. You're making a ton of money. The thing is, you're also writing a $200,000 check between the IRS and the state taxes. Let's call the state taxes New Jersey for this example. So how do we fix this? How do we pay the least amount of taxes legally? Should we convert to an S-Corp? So we look at the S-Corp and say, okay, what's the point of the S-Corp? And the point of the S-Corp typically is to save money on Social Security tax. The thing is, there's this other thing that's still valid for 2025. Hopefully they'll extend it with just Trump, extension. QBI will exist because right now it's expiring. 2026, it's no more. We'll see, I think today or next couple of days or weeks, we'll know if it's going to be something for 2026. It's the 20% deduction, as long as you're not a SSTB, you're just a normal businessman, you're not a doctor, you're not a lawyer, you're not an accountant. 20% of your net income from your business is a deduction, so you'll only pay tax on the 80%. So essentially, that basically means that you have to increase your salary. So if you have $1 million net after all your expenses before salary, the sweet spot is about 30% in salary. So a $300,000 salary, 50% of that is 150,000. So now when you do the 20% on your net income, so let's say net income of 700,000 times 0.2 is 140,000. So that's the QBI deduction. You have a salary of 300,000. It's about 150,000, half of that. So you can get, as long as you're below that 50% of the W-2 threshold, you can take the full 20% of the 140,000 on your $700,000 net income. It's a little complicated, but you do the math, that's sort of what's going on there. So having an S corp because you're having salary is great. Now some businesses already have payroll, so if you already have payroll, then maybe it doesn't matter because it's limited to payroll. So if you have a sole prop and you have or an LLC that's a single member LLC and you have payroll, you can get QBI there. The thing is, you know, now you you can there's every business is different, so all the different planning is different. So there's another thing called PTE, tax planning and payments, where you can take tax for your New Jersey tax or any tax that any state that has tax as a business write-off, so you reduce your federal income because that whole $10,000 cap, which we used to be able to itemize, is not very helpful anymore. So a lot of states have adopted this. And really, those are the major things. All the things with your house, your car, your cell phone, all those things could really be done in all the different setups, whether it's S-Corp, partnership, sole prop, single member LLC. S-Corps have a little bit of a nicer flow to things, and it's easier to document, or it's easier to have kind of a system because you can say you're an employee and you have this accountable plan and reimbursements, and sometimes it's a little bit easier to justify that these are like employee type benefits that are taxable and tax free to the employee, because they're like reimbursements. It gets a little trickier when you have a partnership because it's UPE, unreimbursed partnership expenses. You got to have certain criteria there. So those could be done, a little bit easier in the S corp, but that's not the reason why you would make an S corp. It's really the salary, the Social Security savings, the QBI maximization, and now you have an entity where you can do PTE. You can't do that in a sole prop or a single member LLC typically. So those are the kind of things to do. Follow me for more tips on how to save and set up your best and most optimized tax strategy and plan. Have a great day.